going to be talking about the Fed raising the interest rates. Once again, they raised it 75 basis points, if you're not aware. And so I'm going to be talking about what that means for the present time frame, what it means for the future of the housing market, and going over some quotes from Jerome Powell as well, because this interest rate hike should not have been a shock to anybody that really follows the news, meaning that they actually like read the articles and not just the headlines. So we're going to break down the information. If you're over on Instagram, click the link in my bio and join on YouTube. You can actually see the slides that I'm talking about. It'll be a little bit more beneficial to you. But let's get into it. You always catch the replay on the podcast or the YouTube channel as well. So let's get into it. All right. So what did Jerome Powell have to say, right? He says, we'll take into account, we're talking about the hikes potentially in the future. We will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments, right? So what does that mean to you? So the Federal Reserve has raised the cost of borrowed money, the benchmark rate, 75 basis points for the fourth time this year. This is like an historic increase in rates, right? And so a lot of folks are saying like, hey, okay, you're raising interest rates, for the people, basically the short-term rate to borrow money, which impacts stuff like credit cards and stuff like that. But it has an impact on long-term borrowings for like instance, like mortgage rates and stuff like that. So you've done that, but like it's not doing anything, right? So I mean, home prices are going down a little bit, but overall inflation is still high. Like I think when I last looked, inflation was at like 8%. The mission of the Federal Reserve, as passed down by Congress, is to lower inflation down to 2%. So we're at 8% right now. So we're essentially 4 times where we need to be. And so that's why rates are going up like so high right now. And so what's kind of caused inflation? So the Federal Reserve kept interest rates artificially low, during COVID to, try to save the economy, right? And so so I do mortgages, some folks on it from a mortgage standpoint, but when you hear about like 2% rates, when you hear about 3% rates, those are rates that were artificially low and historically low because the Federal Reserve kept interest rates down super low, right? And so those were artificially low. And so for every action, there's an equal and opposite reaction, right? And so that equal opposite reaction is inflation and rates going up super high like this. But going back to the impact these rates have on the average day person like me or you that's looking to borrow money, what a lot of folks have accurately pointed out right now, right, is that corporations, companies are making like all-time high profits right now, right, under the guise of inflation. So inflation is hitting companies as well. And so they raise prices to combat inflation. That makes sense. Any business would do that, small or big, right? But at a certain point, like they're making profit now, like making record profits. So they're raising prices even higher than what they needed to in order to combat inflation. So that's causing inflation as well, right? So I'm just going to say the Acme company, right? Let's say inflation, they can sell product X for $2, right? But due to inflation, now they need to, there's an extra dollar in their bottom line, right? So now they need to sell the same product for $3, $1 more than $2 in order to make a profit. And so companies would do that. They were raising the price of products, which makes sense. But now companies are like, man, we could just blame this whole price raise thing on inflation. So they actually, instead of raising to $3, they raised it to $3.50, $4, $4.50. And that's a lot of what's happening with prices right now. These corporations are just like, F it, man, we can just raise prices and we can just blame it on inflation, right? And so that's what kind of Jerome Powell is talking about when they're like, hey, the effects of this rate hike are lagging, right? And so how does this impact the housing market? And so home prices are going down right now due to increased inflation, right? Back in January, you could get an interest rate of like 3.5% if you had like a 620 credit score, right? But now, modern day, with a 740 credit score, your interest rate is literally twice as much as that, a 6.5%. For point of reference, 620 is like the minimum credit score typically you can get to qualify for a loan program, and 720 is perfect credit from a lending standpoint. So you can kind of see how the Federal Reserve has raised interest rates and how it's impacted the cost to borrow money. And so the next chart I'm going to show you is actually what's been going on with rates. Let's check it out. All right, so if you look at this chart right here, going from November, December, where's my pointer at, highlighter? Where you at, buddy? All right, Bucko. Okay, so you can kind of see rates right there. They're just kind of going flat from basically November to March, right? Because the federal, and so these are not interest rates or mortgage rates. This is the federal fund rate, the cost to borrow money that the Federal Reserve set up, right? And so you can look at this chart right here. That's when the cost to borrow money was like close to zero. I think it was like quarter of a point, right? And so that's why mortgage rates were so low. So it was low for banks to borrow money. And so they passed the non-savings on to you. And so that's why interest rates were so low during that time frame, which led to home prices going up at such a meteoric clip, right? All right. And so what happened in March? They started to slowly like increase rates, right? And so the Federal Reserve prior to today raised the cost to borrow money 75 basis points. So that's why you kind of see this almost like 45-degree angle that rates are going up like this. And so the next chart is going to be how rates have been going historically. And so you kind of see how rates typically go. They do not normally go up like this drastically or this sharp, but the Fed is trying to do something to combat inflation, which is kind of spiraling out of control as we speak, right? So let's check out rates historically. We're going to pan back a little bit. So this is I don't have the updated historic chart, right? This news just dropped today, but so right now the cost to borrow money is somewhere between the Fed's target rate of 4% to 3.75%. So we're somewhere in this threshold right here. So you'll see like news articles pointing out accurately that this is the highest the Fed fund rate has been since 2008, right? And so everyone here is like 2008, right? And we're like, oh no, 2008 all over again. Two different things. And I got like a 2008 chart at the beginning of this presentation, but it is the highest the cost of borrowed money has been since 2008, right? And so what is the Fed going to do now, right? Because we're at a certain point where news, honestly, news drives the economy almost as much as the actual facts, right? Like folks see an article that says interest rates are going down or home prices are going down, and then the folks like, hey, we don't want to buy homes. Folks see stuff, headlines drive the economy almost or to an extent more than the actual facts on a short-term basis, right? And so this is just where the cost of borrowed money has been the last couple of years here, right? And so another quote from Jerome Powell, because the original guidance that we got from the Fed when they raised the cost of borrowed money back in September was that they were going to raise the cost of borrowed money 75 basis points today, which is why if you listen to the podcast or listen to me, I pointed this out like over a month ago. Like this wasn't like some great prediction I had. I was literally just regurgitating what the Federal Reserve put out as the information. And so, and then I think they meet again in December, right? And so the guidance back then was they're most likely going to raise the cost of borrow money another 50 basis points in December as well. And so, but here's kind of an updated quote from Jerome Powell on what is what or what may happen, right? So the committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over again, right? And so they're still targeting that, but also the some other guidance they got was that there may be kind of a change or stabilization in what's going on with rates or what's going on with the guidance with interest rates, right? And so this is kind of innuendo. This is from an article I read in CNBC. Folks are hoping, and I guess maybe folks that kind of move in a circle say you or I don't move, that what the Federal Reserve may realize is that, hey man, these rates are just they're too high, like it's hampering the economy right now. At this point, is that hopefully the Federal Reserve during the next meeting may actually lower the cost to borrow money 50 basis points, right? And don't like be like, yeah, you know, rates are going to go back down. We're going to go back down to those 2-3% interest rates. No, those are gone essentially forever, right? Because once again, the rates were artificially low during that time frame. That is not a realistic thing that will happen in anytime soon, right? But they will hopefully, lower rates down, and then from there do small increases, right? Because they think that rates are just too high right now. So instead of the target being at like 4 to 3.75%, maybe that target rate will go down to like 3.5% to 3.25%. Then they can like gradually increase the cost to borrow money at that point, and then kind of monitor things a little bit quicker. Just because, once again, headlines like drive news. As you probably know, you probably see a bunch of, I call them bozos, that just talk. They just point to headlines, and then other folks just read headlines, and then this headlines are sensational. Then everyone kind of runs with news that is pretty much inaccurate because the headlines are just designed to get you to read the article. But folks don't read the article; they just sit on online and they point at headlines like that because they don't really have any content or any like actual like intellect, right? They just want to get likes and shares, right? And so that's kind of what may happen with rates in the future. So that is kind of a quick update on what's going on with the Federal Reserve raising interest rates 75 basis points. And so where will rates go in the future, right? Well, the projection, the guidance is that rates honestly will probably be, and this is per Fannie Mae, will probably hover in the 6% threshold, maybe the high 5% threshold, all the way to 2023. Because once again, they may lower the cost of borrow money in December, but they're still going to be small, just smaller ticks up in 2023 until inflation gets under control. And then what do you know? Election year comes up after that. So who knows where policy may go during that time frame. And one thing I read from Jerome Powell a little bit ago, or it was an article about what Jerome Powell may be thinking, I wish I could credit the source, was that 2024 elections coming up, right? And so new election could be new leadership in power and therefore new guidance. So the Fed is trying to do what they can now while they know at least what the leadership in power right now is going to do. And so I got a couple quick slides for the folks for the 2008 crowd, because it's like, it's 2008 all over again. Because once again, just want to show you 3 charts, right? Why this is not like 2008 all over again. And then if you have any questions, I can ask you the chat, but you can drop them in the chat. Now we'll answer all the questions once I'm finished with these few slides. So maybe in like the next 5 or so minutes, right? And so one thing that's important to point out, like this time frame compared to 2008, is that lending habits are a lot stricter now than they were in 2008, right? So if you look at the number of people that had like 620 or really 660 credit scores or below compared to modern day, like it's like maybe 10 times as many, right? And look at how many people have like a 760 or above credit score. So everyone will say, my credit score doesn't reflect me, but on average, your credit score is a snapshot of your financial responsibility for the average person. That just is what it is. So credit scores are a lot higher because lending standards are a lot higher than they were in 2008 when it was just the wild west and there were no income loans and just, hey, you make 100K at the gas station. All right, 100K, you can get a loan. That's really not what's going down right now, right? And so also another thing, there are a lot less adjustable rate mortgages than they were back then. So what an adjustable rate mortgage is, if you don't know, is basically how you lock in a lower interest rate for a certain period of time. And then in 5 or 3 years, that rate then adjusts to whatever the market rate is at that time. So if you locked in like a 4% interest rate, back in, 2007, and then, back in 2002, then the rate adjusted back in 2009 or whatever. That's what happened with a lot of these interest rates. And now your interest rate went from a 4% to a 7%. And then now your payment went from $1,500 to $2,200. And now you can't pay the mortgage. That's what happened to a lot of folks back in the 2000s, which is why a lot of folks defaulted on their loans. But a lot of folks are just locked in at low interest rates. Once again, like if you got a good interest rate at 2 or 3%, you're totally unimpacted by this news, right? So all right. So once again, there are a lot less adjustable rate mortgages now than they were back then. And then my last chart is, what is this? So this this chart right here just shows the percent of people that have mortgages at less than whatever the market rate is now. And I mean, the vast majority of people have mortgages that are well under the market rate. So once again, just because rates are 7% right now, if you got a rate at 3%, 8 months ago, your rate is still 3%. You're totally unaffected by interest rates. The value of your home may be going down, but you shouldn't really be purchasing a home unless you plan to hold it for at least 3 to 5 years. 3 to 5 years is like the minimum amount of years you can hold a property and legitimately expect to actually see a return on your investment from an equity standpoint, because typical appreciation in a normal market is 1 to 4%. That just kind of is what it is. So that is what's going on with interest rates. If you guys got questions, drop them in the chat. I will check out if there are any questions right now. So if you guys got any questions, feel free to let me know, whether it's on what's the thing called, YouTube, or it is on Instagram. So I'll stay here for 10 seconds until you guys got questions. If you got value, feel free to hit the thumbs up on the video. That will boost my morale a lot. And honestly, the more feedback I get on videos, that means you guys like it. The more videos I can do for you guys and provide more interesting content for you. So if you got a question, let me know. I'm gonna do my 10-second countdown. All right, so if you got a question, drop an X so I know it's coming. But 10, 9, 8, 7, 6, 5, 4. I don't know if that's a clap or a question, but so hit like you get. If you like the video, I say hit the thumbs up on the video. I'm not sure if that's a clap or a question, but 4, 3, 2, 1. All right, so appreciate you joining the live. No questions. I will go about my evening. So thanks. For you guys that are watching on, appreciate it. For you guys that are watching on Instagram, if you jumped in a little bit late, you can catch the full replay on YouTube, or you can check out the podcast. I will drop an audio version of what happened tonight as well. So I will tap out of here in 3, 2,